Good morning, Andrés. We have just now announced Intrum's financial results for the third quarter 2024. Intrum has made some meaningful progress in perspective of the strategic plan. I am particularly interested in the efforts made to strengthen our financial profile. But before we go into that, let's look at the financial results for this quarter. How would you summarize the commercial development?
Good morning, Christine. So the quarter is a seasonally slow quarter, which was actually a little bit slower than we anticipated. But thankfully, because the first and second quarter we had outperformance, year to date, we're on track, heading into what is a very strong, expected to be a very strong fourth quarter. Specifically in servicing, we continue to win in the marketplace. We had 197 million SEK of new contracts signed during the quarter. Not as high as last year, a little bit lower than last year, but still one of our highest quarters ever. So the commercial development continues, and that really underpins our servicing business, which is now performing dramatically better at the EBIT level. So EBIT year on year is up 45%, driven principally by an expansion in margin. A year ago, we had a 12% margin in the third quarter of 23. This year, in the third quarter of 24, we had an 18% margin, an expansion of 600 basis points. Year to date, we're at 17% on a trailing 12-month basis, and we are on track to hit our target at the end of the year, which is close to 19 on a margin basis. We have consistently said that one of our most important targets is to hit 25% at the end of 26. We are well on track for that for servicing. In addition, during the quarter, it's very important to note that we've agreed to, but not yet closed, 5 deals with Cerberus as part of our capital partnership. While that is an investing activity, it's important to note that those 5 deals will probably generate over 30 million of revenue for our servicing business. So on the servicing front, things are all moving in the right direction.
Okay, so that's interesting. But if we flip over then to the investing business, we're moving towards a capital light business model. Does this show in the results?
Well, yes, it does. Of course, year on year, given that we have a much materially smaller book, given the back book sale that we did to Cerberus earlier this year as a way to raise liquidity and to approach the recapitalization with a stronger foundation, we have a smaller book, and therefore just year on year, direct balance sheet investing profitability is lower. But it is important to note that we are still investing. So we invested over 300 million SEK during the quarter, a little bit behind our run rate, but we're going into the fourth quarter with a very good pipeline. That was done at 20%. That is all fantastic. We collected at 98%, which is a bit under 100, but year to date, we're at 100 against active forecast. The 98 is actually 106% against underwriting, and the 100 year to date is at 107%. So it's very important to realize that our revaluation process, by definition, incorporates that overperformance, and we should be right at or around 100% against active forecast. But relative to original forecast on underwriting, we're well above. And then during the quarter, we did do these 5 deals that I referred to earlier with Cerberus, which is very important. It means our capital partnership has gotten off to a very good start. And those 5 deals will produce significant returns on our 30% share, but also produce probably close to 10 million of investment management revenue over the lifetime of those deals. So as we do that one quarter after the other, and these deals stack up, you can see how investment management can become, over a very short period of time, a very important contributor to our profitability and a key element of our capital light strategy. So investing is also moving in the right direction, Christine.
Good to hear. So let's move from the commercial side to costs. The previously announced cost program, can you please comment on the outcome so far?
Sure. I'm very happy that we've demonstrated in the quarter also a very positive development on our costs. So cost year on year are down 12%. Absolute costs are down 12%. The programs that we previously announced, the 2 programs that add up to 1.5 billion, we've realized a little bit under 1 billion for that. The remaining 500 to 600 million will be realized in the fourth quarter of 24 and into 25. So very good progress on all fronts in terms of our cost development. But we need to stay mindful and on top of our business development and actually enact further cost efficiencies should we feel a need to in the market going forward. What's great is having done these 2 programs, our markets are very mindful of staying on top of our cost, and we need to be always vigilant on cost, Christine.
So that brings us into our efforts to deleveraging. We are slightly up to 4.2 times for the third quarter. Why is that? What's the latest development?
Well, the 4.2 compared to a year ago, it was 4.4. So we have delevered year on year on a ratio basis. In the second quarter, as you indicated, it was at 3.9. We expect, because of the smaller investment book and our continued progression, we expect it to hover around 4 times, 4.2, 4, for the next 2 or 3 quarters, as we get through the next few quarters of deleveraging, as well as we get the recapitalization completed. We will see a step down in that leverage ratio, and we will see continued progress in deleveraging, starting probably the second quarter of next year. That's the anticipated progress on the leverage ratio.
Speaking of restructuring and speaking of strengthening Intrum's financial profile, last Friday, Intrum launched a prepackaged Chapter 11 solicitation. Can you please explain in a very simple way why you choose this process? What are the benefits?
Of course. I want to make sure that everyone understands we have been working with our creditors, as we've stated to the public, for several months to realign our capital structure with our business plan, to allow us time to deliver on this new business plan that focuses on cost efficiency, customer centricity, and capital light investing. I am very proud to announce and delighted to announce that we have overwhelming support from our creditors. 97% of our bank lenders, 73% of our note holders have supported a new plan which extends our capital structure and amends the terms of our debt such that we have time to deliver on our plan. We have chosen Chapter 11 specifically because it is the most efficient process on the planet. We do have a meaningful part of our capital structure that's domiciled in the US in any way. All of our notes are domiciled. All of our senior unsecured notes are domiciled in the US. And it is the most efficient jurisdiction to effect a recapitalization. The word is prepackaged. I think this is very important to explain. Prepackaged means the 73% and the 97% of support holders confirm with actual votes in support of a process. And only when we receive those votes do we initiate a court process that should be done by year end, and that we are assured of the outcome. We will emerge with our capitalization changes as we outlined to the market previously. That is why we chose Chapter 11. After that, and we will be done with the US process by the end of the year, we anticipate that. After that, we will do a Swedish reorganization process early next year, merely to make sure that the Chapter 11 decision is effective in Sweden. And then we will complete the recapitalization end of the first quarter and into the second quarter of next year.
Okay, sounds like a fairly speedy process after all. But just a few words on outlook, Andrés, before we finish.
Yeah, I mean, I think what's evident about Intrum today is that our services, and we see this in the numbers, we hear this from our clients, we hear this every day on a very high number of volumes of interactions we have with consumers. Our services are more critical than they ever have been. We are more important to clients and to consumers, and frankly to society as a whole, as we ever have been. What we've done with the recapitalization is extended the time frame, the runway for us to execute on our plan, which is, as I've indicated earlier, are showing signs of fruit or progress in the direction we want to go in. We want to be more operationally efficient. You see it in the margin. We want to be more client-centric. We want to grow our servicing business. We want to be more capital light, do more things like we're doing with Cerberus, invest our own capital, but also invest it alongside third-party capital. I believe that over the coming quarters, you're going to see continued progress. Over the coming quarters, you're going to see the closing of the recapitalization. And then we have 2 or 3 years where we have to transition to delivering on our plans. And the organization is completely geared up for that. So I feel good about where we are. To wrap up, the quarter was slightly weaker than we expected. Year to date, we're on plan. We're going into a very strong fourth quarter. We are doing many things to set the foundation for sustainable profit.
Okay. Thank you so much. It feels like we are checking some boxes after all. Thanks a lot for your time.
Thank you, Christine.